the bull is not dead. The market is going to get chaotic. Get ready to buy on the way down. Start small, increase the purchases. If you can have the discipline and professionalism to make the largest purchase the last one, it'll pay dividends. And then as we rise, which I'm convinced that we will, and start moving back again towards 4,500, don't be a pig. Pigs get slaughtered. Remember to sell out part as you go.
Maneco 64, home of alternative economics and contrarian views. Well, today is Friday, October 24th, and I've got Peter Carlin, who co-wrote A Pocketbook of Gold with Jim Sinclair. He's been on a couple of times, and if you haven't bought the PDF version of the book, there's a link below in the description. The real book, or the hard book, of course, is really hard to get and a lot more expensive. But we're here today to talk about the correction we're seeing right now since Friday last week with Peter. So Peter, welcome back to the channel.
Good to see you, Mario. How you doing?
Yeah, I'm doing well, and it's funny because you sent me an email and you said if you don't have any physical, make sure you run to Stacks in Manhattan and get some junk silver. And I was telling you before we started that I've been to Stacks before, but I was thinking, well, I am going today. Even before I read that, I was thinking I'm going to go on Friday to London, because to my London Stacks to get some junk silver. I love the junk silver coins, and I might get some numismatic coins too.
Yeah, it's got a lot of utility. I mean, if anything, the past movement that we're seeing now after the big move up, should be telling everybody, this is getting to be your last chance to get physical. While I didn't agree with everybody else that there was an actual silver shortage in the market, when everybody starts screaming about shortages, and I think in your last interview with me, I said, the silver's there, but they're pulling the offers to try and get people to reach. And that's exactly what happened. People did reach, and then the market came off right after that kind of movement up. So you have to be careful of the games that the traders in this market play. And the lesson really to take away from this, as Jim would always say, is, get off margin. If you're trading on some highly leveraged platform and you're day trading, you are going to get killed. You cannot scalp this market against COT, especially in silver. You'll never win. And if you're trading silver on margin, as Jim would also say, you need to see a psychiatrist, because you're never gonna the COT silver pit, on COMEX has got the best professional collection of locals, what we call jobbers in the UK, anywhere in the world. And they will have your arm off in the blink of an eye. They'll see you coming a mile away, even if you're not standing in the pit. And so you have to be very careful what you do, and putting margin into the equation isn't what you want to do. You have to keep a discipline about things. And it plays with human psychology quite a bit, because when a market goes up, everybody feels reassured. And that's how you end up, chasing strength. And remember, the biggest thing, I'm sure you remember that Jim used to say literally almost every week, if not every day, do not chase strength in gold. Do not chase strength. But it goes against human nature, because people want comfort, and a rising market gives people comfort. When the market falls, which is when you should be buying, is when everybody panics and sells out. And that's why the day traders always lose, because they're playing a ridiculous momentum game that they're not going to win. The key, and as we look at the market here today, is to try and develop a strategy for orderly purchases on the way down. Now, I don't know if you want to pull up the first gold chart.
Is that the daily one?
Yeah, the daily. Yeah.
Do you want the close-up one?
Okay, yeah, let's do the close up first.
Yeah, let me bring it up.
Because what you'll notice here that went on, and we have to remember this is under the rubric of stop trying to hit home runs on margin. It doesn't work. So you can see the power up trend there, and one of the things that really showed us that we were getting into a very uncomfortable place was that movement up to the red bar to the left of it, not the one on the right hand side, but the one previously. We got a plus 3% move in gold in one day, and that's the one. And it's highly unusual to get that. So when you see a plus 3% move in one day, what you need to do is say, is that a plus 3% move coming out of a big low, which might signal a bull flag? Or is somebody juicing the market to get everybody in before it sells off? And of course, it was the latter, because we've been going up now, not only for years, but significantly since we went through 34.43. If you want to look at the weekly,
Yeah, this one here. Since we broke.
yeah, you can see the congestion exactly right in there. You can see the congestion right around there, and we've been going up ever since that. So the 3% move tells me that somebody's juicing the market into a high, because we're not getting 3% moves anywhere. And that was the signal for the fact that we were probably going to get a turnaround of some type. Also, 4,500 is major resistance, and plus 50 in silver was another confirmation. You better start to be you better get your hand on the trigger finger and get ready to shoot.
Yeah.
And get out of this thing if you're trading. Now, this has nothing to do with your core position at all. This is just from the trading zone.
Yeah, Peter, I remember when this triangle was evolving, I measured the beginning of the move, which was beginning of the year, basically around 2,600, and it was $900 to 3,500. And then when we broke here, I added $900 to the breakout level, which you said was 34.43, and I came out with 4,300. And I did say at one point, I think when we were around here, that I didn't expect any corrections until 43, 4,400.
Right.
And so it kind of has worked out, this formation. The question now to you, and I guess everyone probably is asking, how long is this correction going to last? Because the fundamentals for gold and silver haven't changed. We're not seeing the Fed or the Bank of England raise rates. We're not seeing the governments getting religion and running budget surpluses.
No, you're not. So if you go back to the other daily, not the close up, but the regular daily, you'll see that red line, the main trend line, you can see the power up trend that we had. Once we broke through and lost it, we went up and retested again, and then we failed. So power up trends like that don't last very long. That's almost vertical if you look at the slope of the line. So the main trend line in red that you see, we touched down perfectly on it a couple sessions ago. And that's the one we're going to have to contend with today. That's the one we're going to have to contend with now. If we lose that, we've got a fairly decent shot of getting back towards the 3,500 level, which I know is going to scare the dickens out of everybody, but it shouldn't, because that's your opportunity if we break through that. And that's when you start thinking about buying. Now, if you're convinced we're going to go straight back up, you might want to consider buying lightly here, because you want to scale down on the buying. And so that means your smallest purchase is the first one. And always remember the golden rule that Jim used to give. If you've had a big move up and you're long, sell 1/3 of your position to buy it back at a lower level. If you never get the opportunity to buy it back, shut up and celebrate, because you're 2/3 long and going through the roof. But when you get these really sharp upsloping moves, you usually are going to see the market come off, and it's healthy for the market long term. Markets going straight up without retracement, are never healthy. So if we get through that red trend line, the main trend line, then we've got a decent chance of getting down towards 34, 34, 34, 34, 43. And that would be a place to put in your second purchase. But make sure you size things properly so that you can weather the storm on the way down, not that you start to go all in. So another reason why you need to segregate your book between core and trading positions.
What about, sorry, Peter. Sorry.
Yep.
What about like physical? Do you think that would be a good opportunity to buy more physical if we get
Absolutely. Absolutely would be.
Because you mentioned in your email to me earlier this week that well, and you said it right in the beginning of this chat that you think it's going to be harder and harder to get physical. What did you mean by that?
Well, what I mean by that is that I think the thing that we're moving towards now is not only is it going to be harder to get it from dealers who don't want to let go, but it's good to have some physical that you keep out of the reach of the rest of the world, so to speak, and that you take physical delivery, and if there's a really manic run, like for instance, let's look at the past week. The news story that seemed to get squashed in the all the movement of the markets, right? This attack on the Romanian and Hungarian oil refineries is a significant marker alongside the breakdown of the Budapest meeting that was supposed to be between Trump and Putin. Now, this wasn't Russia who did this. Now, if you look at the drone incursion into Poland, which may or may not be real, may or may not be actually something that happened, or somebody took a bunch of drone parts and threw them into Poland. The media coverage was nonstop for weeks after it. We've just had a major attack on two oil facilities that looks like Nord Stream Take 2 on both Romania and Hungary, countries that are decidedly not interested in going to war with Russia, and the media is completely quiet. And that's why gold has turned on a dime. Gold was up 5% a couple days ago on one day, and is up something like 10%, 12% from its lows, just a week ago. And this is big news. I think the sad part of this is that the doors for peace are getting shut.
Yeah, I saw that. Sorry to interrupt you. I saw, I think it was from Alex Kreiner. He on his Substack, he was talking, EU declares war on its own members. And he talks about these, is that Hungary? What was the other country? Is it Romania?
Romania.
Yeah, because at the same time, because they're still buying oil from Russia, and I think on that same day that these refineries blew up, they decided to impose more sanctions on Russian oil, but only from like not right away. So yeah, that's really and the only place I heard of this was from the Substack. I didn't see it anywhere. I didn't even see it on X, but from the people that I follow who are quite open-minded, so to speak.
Yeah, but that's why it's good to look at other markets too, because many people, not a lot of people know this. It might have changed, in the past 10 years, but in the 80s and 90s and the first part of the noughties, most banks ran their gold and oil books were very closely related. If they weren't sitting together, the smaller trading teams actually handled both books because those are the ones that are hypersensitive. And back in the 80s and 90s, there used to be a lot of talk about there was correlation between the markets. And while obviously that hasn't been the case in the past half a year, or even the past year, there is some type of symbiotic relationship between the two. And so when you see gold up, when you see oil up 5.5% in a day, you got to ask yourself what's going on. That's why it's important to look at other markets as well. And one of the things I would say to people too, that they really need to be careful about in this gold market that we're in right now for the short-term traders, or which I don't always agree with, trading short term, or people with a medium term look is, we've got this war situation. We've got the Democratic Party declaring war on all Republicans all over the United States. We've got a situation where bankruptcies in the US are soaring. If we get a stock market sell-off, trust me, gold will, don't trust me, but gold will likely sell off as well as people run for liquidity. But you've got to see that as the opportunity. So everybody on planet Earth, not everybody, but everybody who I think is good, Frank Giostra, Jim Rogers, a lot of other people in the equity markets, they're all flat. Equities, they're out. They're out.
Yeah.
And equities are seriously overbought. If we get a big sell-off in equities, it's going to present you with another buying opportunity in gold. And if that sell-off happens, I would say there's a decent chance it's going to happen either October, early November.
Yeah, and
when there's liquidation, everybody goes to the gold book and says, I don't care what it is, sell it.
I just want to show you something here because you're talking about the stock market and equities. If there was to be a big correction, and I agree with you that it's possible because we're seeing these private the private equity shadow banking sector in trouble. We just saw another subprime auto lender declare bankruptcy. I think it was Prima Lending. Before that, it was Tricolor. And this came out on Bloomberg. JP Morgan expects Fed to end quantitative tightening next week. That doesn't mean, of course, they're going to start QE, but it means that they, it's a first step towards it, right?
Yeah, absolutely it is. The closer you get to war, the looser the monetary reins get. There's no way around it. It's just the way it is.
I thought the Trump move to sanction those two Russian companies, that's a big threat to China indirectly, don't you think?
I think it is. I think it is. I don't know what they're playing at, but the Chinese, even though there's some reports coming out today on some of the wires saying how China said that they're going to curtail seaborne Russian crude deliveries. I'm not sure I believe that actually. I think that they might do it as a delaying tactic, but first of all, pipeline will still run, but I don't think it's in China's interest to. They're not going to simply bow down and do what Washington tells them to do. It's not in their book. They're shutting up their economy from America anyway. Pretty soon, exports from China to the U.S. will be zero at this rate. And the Chinese have said straight out, when everybody says a quite reasonable question, well, you're an export-driven economy. Who are you going to sell all of your manufactured goods to? When you lose the U.S. But the U.S. is only about 15 to 20% of Chinese exports. And quite honestly, they've said, we do not care any longer. We don't care if it goes to zero. This is the kind of Chinese mentality you saw with, what's the guy, Victor Young? No, I can't remember his name right now. But one of the big people who was in law school with J.D. Vance, a decade ahead of him. He was Deng Xiaoping's translator. And he said, we do not care. China has been around for 5,000 years, and we don't care. You are talking about the Middle Kingdom. It's cut off from the world for hundreds of years, and periodically through its history too. During the Ying dynasty and other things when the warlords were carving up the country, it's not going to get them, to back down. So I don't know where this goes, but right now it's not. Right now, we're looking at the last chance for peace, and that's one of the reasons why I say, you better start thinking about getting physical now before it gets sequestered or hard to get, or it gets taxed, or you could wake up tomorrow and they could just say, all gold purchases in the USA now, carry a 20% tax on them.
Yeah.
That's going to change the market.
Talking about China, like you said, they don't care, and I agree because they had their century of humiliation, so to speak, and now I don't think they're, like you said, they're not going to bow down to anyone. But I also think they're focusing on gold a lot. They want to make gold a huge part of their not just industrial base, but also monetary base. And someone sent me this the other day, and this is from the Chinese government. I have the other part where there is the header, but so they even have a plan, business summary interpretation of high quality development implementation plan for the gold industry. I mean, they're really serious. And if you look at all these targets and
Yeah.
stuff,
Yep.
just wanted to show you that. Oh,
Well, you'll
Peter,
never keep gold out of the Asians' hands.
no, just one more thing for the viewers. I mean, I remember I started following JS Mindset around 2002 or three, and then there was a group within JS Mindset. Well, not a group, but we were called SIGA, which is Comrades in Golden Arms. And I remember there's a SIGA Pedro. And so maybe you want to tell the viewers who SIGA Pedro is or was.
Was. Yeah. Sigo Pedro, who was a big writer on JS Mindset for years, is me. Um, long before A Pocketbook of Gold was published, I was one of the main writers for Jim, for JS Mindset. It was an honor to do.
Yeah.
Of course, it meant I got to talk to Jim every day too, which was great.
Yeah.
So that's a big revelation for those of you who followed the mindset and were always wondering who Siga Pedro was. Well, now some 10 years or more down the road, it was I.
Peter, did you see Scott Bessent, the Secretary of the Treasury, the other day, or could have been yesterday or the day before? He said the way gold has been going up has been good for us. What do you think he meant by that? Do you think he means that it's good that the dollar's getting devalued versus gold, or that they may be thinking of revaluing it to the statutory price?
Could be a combination of both, but I mean, in a strange way, they built up a monumental amount of inflation in the economy. And like you said, they're not controlling government spending. In fact, they're doing the opposite. It sounds like what he's saying is go ahead, debase the dollar. It's exactly what we want. And remember, 6 months ago, everybody was talking about we're going to get Plazo Accord 2. Maybe he really doesn't care that the dollar is going down. I mean, we know the Trump administration, generally speaking, wants a lower dollar, and that's hard to do because the competition's pretty stiff out there. When you think the euro and the yen are your only two other players, you're going to have trouble weakening it. But I find it a strange thing to say, but there you go, because he's literally saying, don't have faith in your national currency. Who cares? Don't buy treasuries, and we'll get to the Plaza Accord, take two by hook or crook, even if it means trashing the dollar first this time. And, the thing about that is you can do that for so long, but then it really builds up a problem for equities, at least in the short term, until everybody realizes, and I think this is true, that there will be no other place to go except gold and equities. I mean, when you think about it, are you going to put any money in the bond markets of Europe? No. Are you going to put any money in the stock markets of Europe as they go to war? No. Can you put money in the Chinese stock markets? Difficult. You better be careful. You could get shut down pretty quickly. Do you put money in the Japanese stock market? Yeah, you can, but you better get in a fund that manages the dollar risk against the yen. So you're kind of running out of choices. No bonds. You don't want to be in government bonds. Okay, high yielding corporate equities, yeah, but you're only going to get 4% or something. So, and they've been stoking the alpha in equities for God knows how many decades now. So we're probably going to get one last unbelievable, fantastic move in equities up to ridiculous levels as all the money from Europe and the rest of the world comes flooding into U.S. equities, which is exactly what happened during, prior to World War One and World War Two. When the war itself commences, that's a different story. But in that case, it could be the fact that what they want is a lower dollar to keep the equities high. Of course, you're never going to make back what you lose in currency denomination against the equity rally, but this time might be different. But I guess he's just doing what people do. He wants the dollar down, and he's willing to just come right out and say it.
Yeah.
He wants the dollar down.
I wanted to, someone said,
it beats raising taxes.
yeah, sorry. And what about
I said it's better than, sorry, I didn't hear you.
Yeah, it's easier than raising taxes because it's raising taxes is always controversial, not very
Right.
popular.
Right.
Someone sent me this because of what's happening in the volatility in gold. This is a little bit exaggerated, of course. It's the Weimar German mark, paper mark during the hyperinflation, and that's the price of gold. And this
Right.
is the volatility in the market. Can you
Right.
imagine sitting through this? But getting out as well would have been a big mistake, getting out of gold. Do you think?
Yeah.
I mean, this is not where we are right now. Maybe we're maybe over here in
Well, I will tell you one thing for sure. This is, as Jim would say too, this is not the way gold bull markets end. This is not the way they end. They end when you lose like, 20% in a day and the open interest contracts drastically in a heartbeat in one day. The thing that scared the market out in 1980 was the drop in open interest, because it told them that the major player was getting out of the market. What Jim had gone to Jarecki at Makata the night before and turned over his book to him. He had kept the whole office in overnight and told them, call your wives and family, your whoever you need to call, and tell them you won't be home tonight. And he kept the whole office in over the night, and they sold the entire position out in Asia, in Japan and India, Hong Kong, Singapore. And then he walked to Makata, my old clearing firm, with Jarecki, and said, here's the book. How much do you want for it? And he handed him the futures position, and he handed him the physical position, which was now completely flat. And he said, I don't know. I'll take, don't hold me to this. I'll get the right number for you. He said, I'll take 5% or 3% or something out of it. Or I don't know what it was. Maybe it was 15 or $20 out of the perfectly matched book for you, and handed it over for him to unwind. So he did a reverse EFP. Open interest crashed when the market in the futures market opened, because when you're running a global metals firm and somebody just hands you that money, it's easy for you to trade out of it because you've got the inventory and the customers everywhere. So, and the book was perfectly matched. And so the open interest leaked out of the market, and everybody knew that was it. $150 down in a day.
Yeah, Henry's.
When the bull ends, you're going to see a catastrophic move.
Yeah, Henry Jarecki. I have a book by Franz Pick. Have you heard of that book, The Death of
Which
the
one?
Dollar?
Yeah.
Yeah, and he talks about how he worked for Makata, Henry Jarecki, and it's an interesting book. And what else? I wanted to ask you something, but
Well, this isn't the way that bulls end.
oh yeah, sorry, I remember. Sorry, Peter, I remember. The other thing as well that makes me think that this is not a top, is that the gold silver ratio is still above 80, and usually in a precious metals bull market since 1971, that ratio really dropped sharply. It dropped to 16 in 1980 and 30 in 2011.
Right? Yeah. I mean, it could do again. It's certainly a barometer. I'm a firm believer that when the market gets really crazy, silver does lead gold because the locals see the gold move coming. COT sees the gold move coming, and they start absolutely ramping the silver market in anticipation of it, which is where you get the big alpha, but it's also where you get the gaps. The thing is for anybody who's not just, first of all, like I said, segregate your investment. Don't touch the core position. You may need it until the end of your life. But if you're coming in and out of the market, get a strategy in mind for where you're gonna plant your purchases, because if we get really, really volatile, you could see a dramatic sell-off. And each one of those things, believe me, the smart people are going to be buying them on the way down. The thing about it is when the market takes a big hit, you have to have the contrary opinion. You have to have a contrary stance to realize that it's an opportunity for length and not a place to bail out of the market. And sometimes that can be tough to do, but that's why in the trading environment in gold and silver, even in a bull market, 80% of people lose money, 20% make. Same Pareto principle still applies.
Yeah. Do you think the public is heavily involved? I don't seem to see here in the UK the general
Sure.
public getting involved. If you ask most people where gold is, the price or silver, they wouldn't know. Even though I've read that the Royal Mint business has picked up a lot in the last year. So yeah, how do you view that? And do you think that we still need to see the public getting involved to
Yeah, I think we do. I think we do need to see the public get involved. But the problem that I worry about now is I'm not so sure that the public, for gold is in the United States anymore. It might be in China.
Yeah, yeah, I
So
think yeah,
check
you
out the
could be
euro.
right. And there's
Check out.
no Chinese investors back in the 70s and well, late 70s, 1980. Uh, and yeah,
Yeah, they've got a lot more money now. So I would say that you have to look at the Dubai Souk, the Yarawat Road in Thailand. Take a look at what's going on in Hong Kong. Somebody should be out there with a camera measuring the lines every day.
yeah.
That would tell you a lot.
Even in Australia, there was a line or a
Yeah,
queue the other day, but it was during Diwali, so a lot of people in that line were like Asians.
right.
Any final thoughts? Because I know you have some time constraint.
Yeah. Um, the bull is not dead. The market is going to get chaotic. Get ready to buy on the way down. Start small, increase the purchases. If you can have the discipline and professionalism to make the largest purchase the last one, it'll pay dividends. And then as we rise, which I'm convinced that we will, and start moving back again towards 4,500, don't be a pig. Pigs get slaughtered. Remember to sell out part as you go. Stay off of margin. Do not try and hit home runs. This market is volatile enough without having to look for margin. If you want volatility, buy silver. You'll get plenty of it. All you can use.
And I guess as well, keep your physical. That's
Yes,
something completely different. You just hold it as insurance. Uh,
absolutely,
yeah, yeah, that
absolutely.
sounds good.
And don't let it go. Keep it with an iron grip, and don't go all in. Be prepared. Don't go all in at one point, and don't go all in at all. If you're running a 30% allocation with your cash position, you're going to be fine.
Yeah.
If you're running 75%, you better have very nimble feet.
Mm. So Jim he forecasts almost to the dollar, very close, that gold would go to 900 back in the early 70s because he calculated the debt that the US owed to foreigners divided by the gold holdings. And nowadays that level is like 36,000, which you don't
Yes.
think uh, it's not gonna work out like in the 70s, but have you got any idea where, let's say by the end of the year, maybe beginning of next year, where gold and silver will be?
None whatsoever. I actually believe that there's a fairly decent chance that within the next month we'll be lower than where we are now, but it will be an opportunity. I think by the middle of next year, we'll be tilting at the highs again, if not going up towards 5,000. And the other thing I would like to say too is that people like to prognosticate about, the ultimate level of gold. And quite honestly, it's not really the right way to think. Keep your eye firmly fixed on 5,000. Keep your eye fixed on 6. As Jim would always say, wait till we get there first before we start talking, crazy numbers. Because as Jim always said, back when we were trading at 1,600, Jim would regularly say, as if you think you want gold to go to 5,000, you need your head examined, because gold's going to be the last of your worries when we start getting towards 6,000, 7,000. It's going to, and I see Frank Justra also said the same thing a few days ago. So everybody who's sitting around with 10 1-ounce coins, dreaming of a down payment on a house in the Hamptons when we get to 50,000, just knock it off.
Yeah.
That's not what this thing is about. You get yourself planted on sell-offs for a move from, say, 3,400 or even 2,900, for a move from there to 5. Worry about that and stop worrying, stop getting excited over the fact that we might be going to 10,000.
Yeah.
Because
maybe it was unfair to ask you that question. I try not to think either
Yeah.
of where gold's going to go. I just know that the currencies are going to go a lot lower eventually.
Right. And remember, there's one thing too. Otherwise, you'll commit the cardinal error of the old gold bugs from the 70s. They held on all the way down from 900 to 220, all the way down, talking about how we were going to go to 10,000. So they did it all during the 80s, the 90s, the noughties. Before long, you're going to die before you ever realize it.
And Jim said, though, that the next big bull market, which I think we're in, it wouldn't be like the 70s and 1980, that it wouldn't correct as much. Is that because he thought gold would become part of the monetary system again?
He did believe that, but he did believe that because it made sense. I think if he saw what's going on in the Trump administration, he might change his views. I don't know whether gold's going to make its way back or not into the system. More likely than not, it's already making its way into individual states' systems. And I think that perhaps is the more salient point. If we look at this like systemic breakdown, you're no longer talking about a Federal Reserve, which is about to disappear anyway, it looks like, or a national treasury that's in charge of every part of the world. So of every part of the U.S. economy, let alone a U.S. Treasury that had the influence that it had globally in the 1970s. It's not there anymore. So it could well be that simply gold is coming back into the monetary system and, could be priced significantly higher, but it won't be something that you see on a trading futures market anymore. It may be something that's happening in Asia or in Florida and Texas, or in Japan but in Shanghai, Singapore. But so I can see gold coming back into the monetary system, which is how he predicted it, but not with the U.S. Treasury, sanctifying it. I don't think that's where. I mean, it could be that they bring it all on the books. It could be, as some people have said, they're going to wake up tomorrow and say, we do not have 8,000 tons of gold. We've got 25, and we're revaluing the dollar against it. That could happen. I don't doubt it at all. But along the way, it's tough to see exactly where we go in the end. It's probably going to be more kind of geopolitical, legislative, but gold is working its way back into the system as we speak.
Yeah.
And I think they're not. Jim always said gold is the last resort. The unfortunate thing is, it looks like we're going to need a last resort, and I'm not prepared to go against that aphorism at all. I think it's truer than ever today.
Well, well said, Peter. Thank you. And I'll keep in touch and talk to you later.
Talk to you later.